Hey, welcome aboard. It's Walter here, and we are going to talk about maxing out profitable trades. Now, the interesting thing about this is that in most cases, for most traders, this is a very uncomfortable thing. And if you think about it, this is a little bit weird, I think, because if you were to go to a restaurant, let's say, and at that restaurant you found that the food was terrible, the service was awful, and it was way overpriced, you would probably want to book the restaurant again to come back, right? The answer is no. You wouldn't want to do that. And the reason why you wouldn't want to do that is because it was no good. And yet, as traders, what we typically do is we will add to losing trades or add to trades that have gone against us so that we can get in cheaper. And if we have a winning trade, we don't do much. We don't add to those. And so what I want to share with you are a couple of methods that you might look into for improving your profitable trades and maxing them out, maximizing profitable trades. So let's talk about what these are. Option number one is that you could simply decide that you're going to risk more. Now, this is quite obvious. This is one of those things like, when I first got into trading and I was working out the math, I thought, well, I could risk 1% and this could happen if everything goes well, but what if I risk 5%? So we know that that's not probably not the best idea, given that the drawdowns will come when you start to risk more. And that's obviously the problem with optimal F and all of those algorithms where you risk more. There are several issues. There are ways to get around that, but typically you end up with greater drawdowns. So most people don't want to do that. And by the way, if you like what you're seeing here, you can go to nakedtradingclass.com and get a more in-depth course for free, for the low price of free, and we'll show you more ways to accelerate the growth of an account. So that's one option. And if you use fixed fractional, that's the Ryan Jones method. We talk about that in the Naked Trading class at nakedtradingclass.com. But essentially, what you do is you ratchet up your risk based on the amount of winnings that you make. That's fixed fractional is the normal 2%, 3%. So if you're risking 2%, how much more would you make if you risk 6% and so forth? Fixed ratio is the Ryan Jones method. That's where you ratchet up your risk, and your risk is actually variable, so it's very different to fixed fractional. A lot of people don't know about it, but that's basically how it works. Is you risk a certain amount, and then after you make a certain amount of profit, then you risk more. It's like a lot size basically. So you might risk one lot size until you make $5,000 profit, then you start risking two lots, and then you make $10,000 and so forth. There are martingale-esque systems that you'll find. These algorithms are rife in the forums. The free forums are rife with these sorts of traders. Typically they're beginners, and typically they haven't worked out the math. I can tell you from testing and experience that if you trade a martingale strategy, you will eventually blow up. So there you have it. Now, option number two is you might decide to do something different. Instead of risking a lot more, you might decide to pyramid. Now, I actually think for some traders, this is ideal. So on this chart right here, this is the pound, but a 1 hour chart. But what we're looking at here is it looks like, it was in kind of this big range here, and then it fell out of that. And then it fell out of it again. Now at this stage, we start thinking, you know what? We might be in a downtrend here. So I put a sell order right here, and then the market goes in my favor. It triggers my sell order. So I wait for it to pause or pull back a bit. Then I put another sell order in right here, and the market breaks below, triggers my trade there. And so what you're doing is you're taking trades every single time the market goes in your favor and goes in the expected direction. And instead of having your stop loss at the original spot, you might move your stop loss as well. So for example, maybe my stop loss is up here on the original position, right? And so what I do is I change it up as the market goes in my favor. So after trade number 2 is triggered, I move my stop loss here. So it was here. After it moves a bit, I might move it to break even, and then this trade's triggered. Now my stop loss is here. Now this trade's triggered, so the stop loss is here. Obviously, if the market comes up and stops me out, I will have some profit from here to here. I will have some profit from here to here, and I will have a loss from here to there, right? So that makes a lot of sense to a lot of traders where you're just pyramiding, and you're reducing your risk. Some traders will only take a certain amount of risk that's equal to what the original position was. So the risk from here to here, and you keep that going for all of the initial positions. So this can work as well. You can see in this case, let's say that we were able to withstand this pullback here. Then in this case, maybe you had your stop loss here or here when you took this position, and then now you're stopped out. So the trade is over. You typically, the last position typically loses money. Not always. Depends on how you go and if you have a target or not. But if you don't have a target and you're just going to let the market go because you're a trend follower, then you'll get stopped out in the last position. This is a loss. This was also a loss in this case, but that was a win, that was a win, and that was a win. So that's how pyramiding works, and that's a great thing to test for sure. A lot of traders like that. Bill Williams, I think, wrote a book, Trading Chaos, where he talks about pyramiding. There's another one. I wrote a book also about pyramiding, a whole course, in fact. There's another option here, which is option 3, and this is to trade lower time frames. The reason why traders get really excited about trading lower time frames is because you trade more often. It's high frequency trading when you do that. Again, if you'd like to learn more about building an account quickly, you can go to nakedtradingclass.com. So high frequency trading is basically taking a lot of trades, whether it's automated or whether you're doing it manually. And when you're doing that, what happens is it changes your psychology basically. The way that when you trade lower time frames, you're in the same mindset as someone who is gambling on a video poker machine, like on a slot machine. So that's the same mindset. You're in a reptilian sort of state of mind where you are very focused on rewards, and that's why trading platforms make noises and flash just like slot machines, basically, because they're made to duplicate that. And the psychology went into that. Psychologists helped design those. So it can be extremely frustrating, and it can be very difficult to be disciplined when you trade the lower time frames. Most traders I know won't make it work, but it's up to you. So if you'd like to learn more about growing an account quickly, you should go to the Naked Trading class. I think it's, I don't know, 30 minutes or so, and we'll talk more in depth about how you can apply different strategies depending on which one makes sense to you, for you, at nakedtradingclass.com. I hope this helps. I wish you happy trading. That's what it looks like when you go to that page, by the way. The video will start and you'll see this magician floating a lady at nakedtradingclass.com. Hope this helps. We'll see you in another video. Take care. Bye.